Let's talk about paying for college. For a lot of families, it feels like trying to solve a puzzle in the dark, right? Well, today, we're going to flip the lights on and look at one specific and honestly pretty debated piece of that puzzle: indexed universal life insurance. You'll hear it called an IUL. The big question is, can it actually be a flexible tool for college funding? Let's dive in and see. So, here's our roadmap for this explainer. First, we'll get into the big challenge that pretty much every family faces. Then, we'll define what an IUL actually is and put it head-to-head with the much more famous 529 plan. After that, we'll look at how your money grows, how you can actually get your hands on it for tuition, and, this is super important, we'll finish up with a really clear-eyed look at the risks you absolutely need to be aware of.
All right, let's kick things off with Section 1, the College Funding Challenge. The subtitle here really nails it: planning for the unpredictable. Because let's face it, when it comes to our kids, our money, and the future, life almost never goes according to plan.
I mean, seriously, you're trying to save for a target that's not just moving, but it's years, sometimes decades away. You've got tuition costs that just keep climbing, and stock markets that can go on a roller coaster ride. Trying to plan for that can feel like a total gamble. And this is exactly where some of the more traditional plans can get you into a corner. I mean, think about it. What happens if your kid gets a full-ride scholarship? Awesome. But what about the money in their college fund? Or what if they decide to start a business instead of going to a four-year school? All of a sudden, a savings account that can only be used for education starts to feel less like a tool and more like a trap. So that need for more flexibility is what brings us to this tool that a lot of people are getting curious about. Let's move into our next section and really break down what an IUL is. Okay, so at its core, an indexed universal life policy is basically a hybrid. It's two things in one. First, it's permanent life insurance, which means it has a death benefit. But, and this is the part we're focused on today, it also has a savings component, a cash value account, that's designed to grow over time. The real key here is that the growth is tax advantaged. You're not paying taxes on the gains as they build up. It's this dual personality that makes it such a unique option. Now, the best way to really get a handle on what an IUL does is to compare it to the most popular college savings tool out there, the 529 plan. So this next part is all about digging into the differences in flexibility and who's in control of the money. This slide right here, this is the heart of the whole discussion. A 529 plan is kind of like a dedicated pipeline. Money goes in for one reason: education. If you try to use it for something else, you're likely going to get hit with taxes and penalties. The cash value in an IUL, though, is more like a general savings fund. You can tap into it for anything: college, a down payment, an emergency, you name it. But here is the biggest difference right here in the middle. An IUL has a built-in safety net. It's called a 0% floor. That means even if the stock market tanks, your cash value can't lose money due to the market. A 529, on the other hand, is invested directly in the market, so its value can definitely go down. That one feature is what gives the IUL its adaptability when life decides to throw you a curveball. Okay, so if it's protected from market losses, you're probably asking, well, how does the money even grow then? Great question. Let's get into the mechanics of how it all works. It all starts with your premium payments. Part of that payment covers the actual cost of the life insurance, and the rest gets funneled into your cash value account. So how does it grow? Well, that cash value gets credited interest based on how a stock market index performs, something like the S&P 500. But here's the deal you're making. In exchange for that 0% floor, that safety net that says you can never have a negative year, you agree to a cap on your potential gains. So let's say the cap is 10%. If the market has an amazing year and goes up 20%, your account gets credited with 10%. You're basically trading those monster home run years for the guarantee that you'll never strike out and lose money. All right, fast forward a bunch of years, the money's been growing, and now it's time for the first tuition bill to show up. So how do you actually get that money out of the policy and into the university's hands? So the most common way to get the money out is a simple 1-2 punch. First, you can withdraw all the money you've paid in premiums, that's your cost basis, and it comes out completely tax-free. Once that's done, you can start taking out policy loans against the growth, also typically tax-free. But check out this third point, because this is where the strategy gets really interesting. Imagine it's your kid's freshman year, and the market just had a terrible year. Your 529 plan is down. Instead of cashing out those investments at a loss, you could use the stable funds from your IUL to pay that year's tuition. You give your 529 plan time to hopefully bounce back. The IUL can act like a financial shock absorber.
Now look, no financial product is a magic bullet, and it is so important to understand the downsides and the trade-offs. This final section is all about looking at the risks and the really important things you need to think about before ever considering an IUL. So let's just cut right to the chase. When is an IUL probably the wrong choice? Here's the bottom line. If your one and only goal is to squeeze every possible penny of growth into a fund strictly for college, and you don't need or want permanent life insurance, then a straightforward, low-cost 529 plan is almost always going to be the better, more efficient option. The real power of an IUL is in its flexibility and protection, but those features come with costs and complexity. And you have to know, this is not a set it and forget it kind of product. There are real risks you have to manage. Those illustrations they show you at the beginning, they can look incredible, but they're just projections, not guarantees. If you miss premium payments, you can seriously hurt the policy's performance, and those caps on your gains, they can and do change over time. Plus, remember, it's life insurance, so your health will affect the costs. The only way an IUL really works as intended is if it's designed correctly from day one, and you commit to reviewing it every single year to make sure it's staying on track. So after all that, it really boils down to this one simple question. When you think about your own family and your own goals, what do you value more? The straightforward simplicity of a dedicated college fund or the built-in flexibility of a tool that can do more than one thing? There's no right answer for everyone, but figuring out your priority is always the best place to start.